And it's wonderful to have you all here as part of a conversation with Tiff Macklem, the Governor of the Bank of Canada. And I think, to have more than 400 people here to come and listen to economic updates and interest rate policy, that's pretty impressive. I think we all want to hear what the Governor is going to be talking about, especially so soon after the interest rate decision that was released yesterday. Governor, we're very pleased that you're here to share your economic progress report as well. And the last time the Bank of Canada Governor was here was 2007. It was Mark Carney. And so it's been a while, so thank you, welcome, and we look forward to the conversation. Before we get into today's remarks and the program, I would like to take a moment to share a land acknowledgement in the spirit of reconciliation. In a few weeks, we recognize National Day for Truth and Reconciliation, a time to honor survivors and remember the history of residential schools. It is a time to recognize and reflect on the history and legacy of residential schools. And it's important to acknowledge the traditional territories of the peoples of Treaty 7, which includes the Blackfoot Confederacy, comprised of the Siksika, Piikani, and Kainai First Nations, the Tsuut'ina First Nation, and the Stoney Nakoda, including the Chiniki, Bearspaw, and Goodstoney First Nations. The City of Calgary is also home to the Métis Nation of Alberta Region 3. And I'd like to recognize and acknowledge that it is our shared responsibility to honor and care of the land, for the lands we are seated on today. We have a few notable guests with us today, and I'm thrilled to welcome the Honourable Lois Mitchell, who served as the 18th Lieutenant Governor of Alberta until August 2020, and David Duckworth, our City Manager with the City of Calgary. I'd also like to recognize our Board Chair and CEO of SureCall, Desiree Mobineau, who's here today as well, and apologize for anyone else who I've missed. We have a full house today. I'd now like to thank our sponsors for today's event. Without your support, nothing happens. So thank you very much to the Alberta Mortgage Brokers Association, BLG, Synovus, Maurer Investment Management, and RGO. Conversations like today are important. Collaboration between policymakers and industry is key to positioning Canada for success. And today is an opportunity to do just that, to bring together Calgary's business community and government and policymakers to discuss the road ahead. And as we look forward, we see that Canada's economy needs to innovate, to attract and retain new talent, to grow our province and our country. Governor, I'm thrilled to welcome you here today to hear your economic outlook for the year ahead and to discuss some of the issues top of mind for business, including interest rates and rising costs, the labor shortage, the importance of a diversified economy, and how to increase Canada's per capita productivity. Now, I want to note that we will welcome questions from our audience members, so you can text to the number on your table card. The Governor knows that I will be checking my phone periodically to make sure that we ask the questions from the floor. And I invite everyone to join the conversation online by connecting us on X, formerly known as Twitter, at Calgary Chamber. Without further delay, it's my pleasure to officially introduce you to Tiff Macklem, Governor of the Bank of Canada. Tiff first joined the Bank of Canada in 1984 after finishing his undergrad at Queen's and held various senior positions, including Chief of Research and Advisor to the Governor, Deputy Governor, and Senior Deputy Governor. During the global financial crisis, Mr. Macklem was Associate Deputy Minister at the Department of Finance and represented Canada at the G7, G20, and Financial Stability Board. He also served as the Dean of the Rotman School of Business at the University of Toronto from 2014 to 2020, when he was appointed as Governor of the Bank of Canada for a 7-year term. Governor Macklem, welcome. The floor is yours.
Well, thank you very much, Deborah. It is a great pleasure to be here. The last speech I gave in Calgary had to be delivered remotely. It is so much better to be here in person. And I want to thank the Chamber, and I want to thank our Calgary office, our Bank of Canada Calgary office, for organizing such an impressive event. And I am very much looking forward to meeting and speaking with as many of you as possible. Monetary policy is working to bring inflation down, and we are encouraged by the progress so far. CPI inflation was 3.3% in July, roughly in line with what we expected in our July monetary policy report. Our 2% target is now in sight, but we're not there yet, and we are concerned progress has slowed. Monetary policy still has work to do to restore price stability for Canadians, and we are committed to staying the course. La politique monétaire fait baisser l'inflation et on est encouragé par les progrès faits jusqu'à maintenant. L'inflation mesurée par l'IPC était de 3,3% en juillet. C'est à peu près la prévision du dernier rapport. Notre cible de 2% est proche, mais elle n'est pas encore atteinte. Et nos progrès sont plus lents. Il reste du travail à faire pour restaurer la stabilité des prix pour les Canadiennes et les Canadiens. On va garder la cap. In my time with you today, I'm going to begin by discussing our recent monetary policy decisions. And then I want to dig into the inflation data and give you a sense of what we're seeing and what we're looking for on the path to price stability. I also want to outline the progress we've seen rebalancing demand and supply in the economy. How these evolve will be critical to our policy decisions going forward. Finally, I want to answer a question we're getting more frequently from Canadians. Why are we so focused on the 2% inflation target? Isn't 3% close enough? Short answer is no. And I'll explain why we're committed to getting inflation all the way back to the 2% target. At both our June and July monetary policy decisions, we increased our policy rate, bringing it to 5%. These were difficult decisions, but they reflected the accumulated evidence that excess demand in the economy and underlying inflationary pressures were both proving more persistent. And it was our judgment that more restrictive monetary policy was needed to restore price stability for Canadians. The data since mid-July are providing clearer evidence that higher interest rates are moderating spending and rebalancing demand and supply in the economy. However, we remain concerned that inflationary pressures are persisting and larger than normal price increases remain broad-based across many of the goods and services Canadians buy regularly. Just as it took longer to see clearer evidence that higher interest rates were moderating demand in the economy, it may now be taking longer for this to translate into lower inflationary pressures. We know it takes time for interest rates to work their way through the economy and relieve price pressures. The other possibility, of course, is that monetary policy is not yet restrictive enough to restore price stability. And unfortunately, the longer we wait, the harder it is likely to be to reduce inflation. In trying to balance the risks of under and over tightening, Governing Council decided yesterday to keep our policy rate at 5% and agreed there may be a need to raise the policy rate further if inflationary pressures persist. Going forward, we will be looking for evidence that price pressures are easing. Each month, inflation data is buffeted by many factors, some temporary, some more durable. Given that monetary policy works with a lag, we need to use a broader set of indicators to assess where inflation is going. So let me dig into the data and unpack what we're seeing and what we're looking for. We've been saying for some time that inflation would be close to 3% this summer. It fell to 2.8% in June before moving up to 3.3% in July. So we're about where we expected to be. The biggest contribution to the slowing in inflation since the peak last year has been from energy, which accounts for 2/3 of the slowdown. Price increases in consumer durables like furniture and appliances have also slowed as supply disruption eased and hiring borrowing costs reduced demand. This is welcome progress. But we know that many prices, Those for food, shelter, and many services are not cooling in the same way. And recently, global oil prices have risen again, pushing up gasoline prices. This is expected to increase headline inflation in the near term. To capture the center of gravity in inflation, we use several measures to look deeper than this headline and assess the underlying trend in inflation. So let me explain the inflation measures we're looking at and why. First, we track measures of core inflation, which exclude large price changes, whether they're up or down, that can obscure the underlying trend in inflation. Core inflation is running around 3.5%. This is true of year-over-year rates, as well as more timely three-month rates. And what that suggests is that inflationary pressures remain and downward momentum has slowed. We also carefully examine the distribution of annual price changes across CPI components. And as you can see in the top panel of this chart, while some prices are always going to be going up and others are always going to be going down, in normal times, price changes tend to be clustered around the 2% target. When inflation went up last year, which is shown in the middle panel, the distribution of price changes shifted to the right. The average price increase was higher, and the range of price changes widened. And you can see in the distribution, particularly on the right side, which means some prices went up very sharply. This points out one of the unpleasant consequences of inflation. High inflation also brings bigger swings in prices. Since inflation peaked in June 2022, the distribution of price changes has started to normalize. But the average price increase and the variability of price changes are both still higher than normal, and you can see that in the bottom panel. Another way to gauge inflation price pressures is to look at whether price increases in the CPI reflect a few big increases or a lot of small ones. And remember that inflation is a generalized increase in prices. To measure the breadth of price increases, we track the share of CPI components whose prices are rising faster than normal. When inflation is close to target, about 30% of the components typically rise faster than 3%. When inflation rose last year, the share of components rising faster than 3% peaked at almost 80%. That's the red line. Today, that's come down to about 60%. The blue line is the share that's rising at faster than 5%. So what you can see from this chart is, yeah, we've made progress, but larger than normal price increases are still broad-based. This highlights another problem with high inflation. No matter how carefully you shop, you can't avoid it. Prices for almost everything are going up, and that includes many necessities. For example, rent was up 5% in July. Home insurance and cleaning products were both up around 9%. Price increases for food average around 9%, and many are in double digits. Bakery and cereal products up 12%, baby food up 11%. Now, the single price increase that is having the biggest impact on CPI inflation is mortgage interest cost. That's gone up as we've increased interest rates. And it's up about 30% relative to where it was a year ago. When you exclude mortgage interest costs from the CPI, what's left is increasing at around 2.5%. And that has led some to argue that inflation is effectively back at target. Now, look, it's true that if we hadn't raised interest rates, mortgage costs would likely be lower today. But inflation throughout the economy would be higher. Inflation would be a much bigger problem than it is today. To measure underlying inflation, we need a more systematic way of excluding components with big movements on both the upside and the downside. Of course, if you take out things that are, if you only take out things that are going up, the measure of inflation you have, of course, looks lower. But that's why we use these core measures to provide a more systematic way. And if you look at CPI trim, for instance, it's excluded mortgage interest costs in each of the last 14 months. Nevertheless, it's still running at about 3.5% because it's also excluded things where the prices have fallen sharply. So the message here is that The underlying trend shows inflation is still well above target. And the longer the underlying trends remains too high, the harder it's going to be to bring inflation down. Now, why is that? Well, it's because households and businesses expect, once they start to expect inflation to be higher, their behavior starts to change. And when that happens, it becomes more difficult to bring inflation back to the 2% target. Looking forward, what do we want to see? We want to see less generalized price increases as well as a decline in the average price increase. Both these things are happening. That is encouraging. But they need to keep happening to restore price stability for Canadians. That brings me to the other factor we're watching closely, the balance between demand and supply in the economy. Inflation has come down from 8% because supply chains have opened up, energy prices have come down, and big price increases of a year ago have dropped out of the data. For inflation to continue to decline, we need the demand in the economy to continue to grow more slowly than supply for a period of time. That will relieve price pressures, slow increases in labor costs, and restore normal price-setting behavior. That's what will bring inflation sustainably back to the 2% target. But I want to be clear. We're not trying to kill growth. We want strong, sustainable growth and a healthy labor market. The best contribution we can make to these objectives is to deliver low, stable, and predictable inflation. Price stability is a cornerstone of a market-based economy. Nothing works well without it. The way we achieve price stability is by using our policy interest rate to find a balance between demand and supply in the economy. Too much demand, inflation rises above the target. Too little, inflation falls below the target. We've seen both in the last 3 years. At the beginning of the pandemic, demand collapsed and inflation fell below 1%. In fact, it even fell briefly negative. We used all of our tools at our disposal to support the economy so that Canadians could continue to pay their bills, businesses could stay afloat, and people would have jobs to come back to when the shutdowns ended. As economies around the world reopened, supply chains became tangled, the demand for goods came roaring back. Businesses couldn't keep up, prices rose quickly, and inflation became a big problem. This shift into excess demand required the opposite policy reaction, and we raised our policy interest rate forcefully to dampen growth, give supply a chance to catch up, and relieve price pressures. So how well is it working? The output gap provides the broadest measure of that balance between demand and supply in the economy. And by our estimates, excess demand peaked in the first half of last year. That's when the economy was the most overheated. Since then, excess demand has eased gradually. Last week, GDP growth for the second quarter was essentially zero. This should reduce price pressures, leading to lower inflation. The weakness in second quarter GDP largely reflected a broad-based slowing in consumer spending and a decline in housing activity. The softening in household spending on goods was most pronounced on larger items that people often buy on credit, like furniture. Together with the decline in housing activity, this points to the moderating effect of higher interest rates are having on household spending. Consumption of services also slowed, which may indicate the effects of tighter monetary policy are broadening from goods to services. It is true that the weakness in overall economic growth was magnified by a few unexpected events, and the most notable of these are the devastating wildfires that we've experienced across the country that are destroying homes, evacuating cities, and weighing on economic activity across a number of sectors. Alberta has been hard hit, and this has disrupted oil and gas production in particular. The labor market is also an important indicator of this balance between demand and supply in the economy. We're seeing signs that the labor market is cooling from overheated levels earlier in the year. This is allowing labor supply to begin to catch up with demand. Employment was roughly flat in July, marking the 5th time in the last 6 months that job growth has been below the pace implied by population growth. So far, we've been able to cool demand without unemployment spiking. As I outlined last November, the fact that job vacancies were at a record high meant we had scope to cool the demand in the labor market without causing a large surge in unemployment. Nearly a year later, what we can see is that job vacancies have indeed fallen significantly, with only a relatively small increase in the unemployment rate. Wage growth, in contrast, has yet to show clear signs of moderation, with most measures running around 4 to 5%. As the labor market continues to come into better balance, we do expect wage growth to slow, and that's something we're going to be watching closely for evidence that confirms this rebalancing in the labor market. Another indicator of the imbalance remaining between demand and supply in the economy, and thus of underlying inflationary pressures, is corporate pricing behavior. As the economy reopened from the pandemic restrictions and many costs rose quickly, companies protected their profit margins by passing on all their cost increases along to customers. They did this by increasing their prices more often and by more. As inflation comes down, businesses are telling us that their price-setting behavior is beginning to normalize. Businesses increasingly expect the size and pace of price changes to decline. But corporate pricing behavior is not yet back to normal, and it appears to be changing only slowly. As long as demand is running ahead of supply in the economy, it's too easy for businesses to raise their prices. We will be watching corporate pricing behavior carefully to be assured that the economy is clearly on the path to price stability. So that's what we've seen in recent months, and that's what we're going to be watching closely. In October, we will publish a new economic outlook. We're going to be looking for continued progress toward this economic rebalancing we need to relieve price pressures, and more evidence that this is translating into lower underlying inflation. So that brings me to a question we have been getting increasingly from Canadians. If it's going to be difficult to get inflation to our 2% inflation target, and we'll be closer to 3% for some time, why don't we just raise the target to 3%? Besides, you have a control range of 1% to 3%. Isn't 3% close enough? Now, we understand why people are asking this question. Higher interest rates are painful, but getting to 2% inflation is worth it. And I want to be clear, we are committed to the 2% target. There are good reasons. First, you don't raise the target just because you missed it. We've been targeting 2% inflation since 1995, and the inflation target anchors our economic and financial system. If you get rid of the anchor or move it when the going gets tough, inflation gets less predictable and more volatile. Nobody wants that. Second, the 2% inflation target has delivered low, stable inflation and lower unemployment rates on average for the last 25 years in Canada. Most central banks around the world have a 2% target because at 2%, inflation is low enough that people don't need to worry about changes in their cost of living one year to the next. Third, the target is not 1% to 3%. The target is the 2% midpoint of the 1% to 3% range. Between 1995 and 2019, inflation was in the 1% to 3% range 80% of the time. But if you want to be in the range most of the time, you have to aim for the middle. If we decided 3% was good enough, inflation would be above the range a lot of the time. The bottom line is 2% inflation is eminently achievable and has served Canadians well. Simply put, when inflation is stable around the 2% target, it removes the anxiety created by large swings in the cost of living. Price stability means households and businesses can plan and invest with confidence that their money will hold its value. I want to make one final point. We review our monetary policy framework, including our target, every 5 years so that we can be confident it remains fit for purpose. Looking ahead, And I will stress this is a strength of our framework. When you look ahead, Canadian businesses, households, governments, they're all going to need to confront some big global forces. These include demographic changes, increasing geopolitical tensions, climate change, digitalization. And some of these forces are likely to add cost pressures and increase the volatility in prices. And that's led some commentators to suggest that this means we should target a higher rate of inflation. Now, understanding these forces and what they mean for monetary policy is at the very heart of delivering on our mandate. But it's not obvious that allowing for higher inflation is going to help us deal with these challenges. To the contrary, more inflation and the uncertainties that come with more volatility in inflation are more likely to make the needed adjustments that much more difficult. These aren't the first structural changes to confront the Canadian economy, and for the past 30 years, the 2% target has been a helpful anchor as businesses, households, and governments face shifting economic forces. As with past reviews, we will work hard to analyze how the framework's been working, and that includes the 2% target, and whether it's the best framework for the future. You'll probably be relieved it's time for me to conclude. We've come a long way in the past year. Monetary policy is working, and inflation is coming down. But we still have some way to go to restore price stability. With past interest rate increases still working their way through the economy, monetary policy may be sufficiently restrictive to restore price stability. However, the Governing Council is concerned about the persistence of underlying inflation. Inflation is still too high, and there is little downward momentum in underlying inflation. La Banque va évaluer de près l'équilibre entre l'offre et la demande et aussi l'inflation fondamentale pour mesurer nos progrès vers la stabilité des prix. La Banque est prête à en faire plus si on doit augmenter les taux d'intérêt pour rétablir la stabilité des prix. Mais la Banque ne veut pas augmenter son taux de directeur si ce n'est pas nécessaire. La Banque sait que les taux d'intérêt plus élevés causent beaucoup de difficultés à une partie des Canadiennes et Canadiens. C'est pourquoi elle ne va pas ajouter à ces difficultés. Mais il sera plus grave de laisser trop d'inflation continuer. On sait qu'une cible de 2% est la bonne. Cette cible est proche. On doit garder le cap. We will be carefully assessing the balance between demand and supply and underlying inflation to gauge progress towards price stability. If we need to raise interest rates further to restore price stability, we are prepared to take further action. But we don't want to raise our policy rate more than we have to. We know higher interest rates are hitting some Canadians hard, and we don't want to make this more difficult than necessary. But letting too high inflation persist would be worse. We are confident that the 2% target is the right target. The target's now in sight. We need to stay the course. Thank you very much. And I look forward to your questions.
This is the fun part.
Absolutely.
For me, maybe not for you. No. Please make sure you do text on the table on your card if you'd like a question asked to the governor. So we're not done yet. You don't think we're done yet? Raising rates. It's pretty interesting.
Well, I think the answer is we'll see. We're gonna take it one meeting at a time. As I just indicated, it may be the case that monetary policy is sufficiently restrictive to restore price stability. The economy has entered a period of slower growth. That is relieving price pressures. That's an important reason why we kept our policy rate at 5% yesterday. We know there's lags in the effects of monetary policy, but as I underlined, inflation is still too high. The downward momentum has slowed, and we are concerned that there's a certain stubbornness in the stickiness of inflation. So maybe we don't need to do more, but maybe we do. And what I really tried to outline in my remarks were a number of the things we're looking at to gauge that progress.
So when you look at some of the news that's coming out of countries like China, and now there's some concern about the United States from an economic standpoint, how could an economic slowdown in China and potentially south of the border affect your outlook and your decisions going forward? Could that have enough of a moderating effect?
It certainly could. We are, exports are a big part of our economy. I don't need to tell you that here in Alberta.
We'd like to export more, but that's another conversation.
The price of energy, price of oil is very sensitive to global demand. So yes, I think if you were to see a sharper slowing globally, there is no doubt that would impact Canada. We have a global outlook. Global growth has slowed this year. The U.S. economy is also adjusting. Inflation is also coming down in the U.S. As we highlighted yesterday, the U.S. consumer spending has proven pretty resilient. I'll let the Fed speak for themselves, but I think they're asking themselves the same kind of questions we're asking ourselves. But yes, I think if the global economy slows more sharply, that will definitely have an impact on our economy, and that's something we'll need to take into account as we take those policy decisions.
So one of the things you did talk about towards the end of your speech was about volatility, and you just talked about energy. So just how can the bank be sure it doesn't underestimate the impact and the volatility of commodity prices again, as it did, and you acknowledged that in 2021 and 2022?
Look, the Bank of Canada can't control global commodity prices. So that's why we're focused on a broader range of indicators. In particular, our measures of core inflation provide a good indication that strip out the volatile components. Energy is often in that bucket. Commodity prices more generally are often in that bucket. And by stripping out these volatile components, you can see more clearly where the trend is. And I think an important message is that fundamentally, it's that balance between demand and supply that's going to determine inflation. We've had a period where demand has rocketed up as we came out of the pandemic. Businesses couldn't keep up. The economy became quite overheated, and that's how you get to 8% inflation. Yes, it was juiced. It was it was pushed up even further by the war in Ukraine, by large increases in global commodity prices, by very tangled supply chains. Those global energy prices have come down quite a bit. Recently they've ticked back. Supply chains are certainly working much better globally. So those things have got better. What we're increasingly going forward, we're focused on this balance domestically between demand and supply. There are going to be fluctuations in inflation. As I mentioned, oil prices have gone up recently, so I think you can expect headline inflation is going to go up in the near term before it eases. We'd get nervous if that starts to feed through to our measures of core, but if the underlying track is moving in the right direction, that's what we'll be looking for.
Well, Saudi Arabia and Russia both announced that they were going to keep production cuts in place until the end of the year, and so that sort of portends that, as you said, oil prices are over $90. So that's going to cause you a bit of a headache, I suspect.
Obviously, if oil prices go up, that's going to impact Canadians. That's going to show up in headline inflation, and that is something we're going to have to evaluate. As I said, we have no control over global oil prices. What we're really going to be looking for is the underlying trend in inflation.
And there's been a number of questions, no surprise, that have come in. So how does the bank plan to manage Canada's growing debt burden what measures will be taken to ensure long-term fiscal sustainability. And I guess the other sort of just to add to that, debt's at about $2.3 billion from a consumer standpoint. So just wondering how you're looking at all that.
Well, the short answer is the Bank of Canada is not going to manage that. That is the job of our elected governments to manage that. Fiscal decisions. Governments have many priorities. They have it's a tough job balancing them. That is appropriately decisions of our elected governments. Our mandate is control inflation. So what do? Is we take the government's fiscal spending, taxing decisions, and their fiscal plans, we take those as given, and we build those into our outlook. And then we take the actions that we judge are necessary to deliver on our mandate for Canadians. I think that's what Canadians expect from us.
The $2.3 billion in consumer debt, does that worry you at all from an economic standpoint?
The Canadians, the indebtedness of Canadians has been trending up for some time. That does create a vulnerability. As long as you can sustain that, that's fine. But certainly, if we were to get into a serious downturn, it's not what we're projecting. We're projecting slow growth, but it's positive. We're not projecting a serious downturn. But if you did get into a serious downturn, and you do, large numbers of people lose their jobs, that's when that vulnerability could really come home to roost, and it could make a difficult cycle that much worse, and certainly for many of those individuals, very tough. As I say, that's not what we're projecting. I don't want to minimize the pain. It's not going to be easy, even with slow growth, but we're not projecting a big surge in unemployment.
You briefly mentioned the slowdown in consumer spending during the second quarter. Is it a soft patch, or is it really a signal that the economy is slowing down?
I think you have to, one quarter to the next, there's always going to be some ups and downs. But if you look over the last 3 quarters now, Q4 last year was 0, Q1 was 2.6, this quarter was minus 0.2 annualized. When you average those, what you've got is something a little less than 1. Yeah. And we'll put out a new forecast late October, but we're expecting growth in that range, somewhere a little less than 1 for next few quarters. So that's slow growth, it's positive growth. If you're forecasting a small positive, you can't rule out that you get a couple small negatives. But that's not what most people think of when you talk about a recession. In our view, that's what's, we need this period of slower growth to relieve those price pressures, to restore price stability. And then when we get there, growth can pick back up, the economy can grow again, inflation, interest rates can come down, and we will have low, stable inflation.
Might be a bit of a tricky question. How is Canada's fiscal policy impacting the Bank of Canada's ability to achieve its mandate? You are independent, and that was made pretty clear when Minister Freeland said what she did yesterday.
I think I've already addressed how fiscal policy fits into the decisions we take. We take it as given, and then we do what we need to do. We do what Canadians have charged us to do. How is fiscal policy affect us? So if you look over the last several quarters, government spending, and when I say government spending, that's all levels of government, federal, provincial, has been running at about 2%. So it's contributing to growth. It's contributing to the growth of demand in the economy. And in that sense, it's not helping to slow the economy. It's not helping to relieve those inflationary pressures. But as I said, we take those fiscal plans, we put them in our models, we come to a judgment about the path forward for the economy. And in our forecast we put out in July, we have inflation coming gradually back to our 2% target around the middle of 2025. So we're getting there. I think the last thing I think I would say about government spending is that if governments were to increase their rate of growth of spending considerably, that would add more to demand, and that would make it harder to get inflation back to the 2% target.
Question, how do the annual increases in carbon pricing impact inflation, and does it impact your decisions differently than any other forms of taxation?
So, as you're well aware, the carbon tax goes up periodically. So when we forecast inflation, we know what the carbon tax is going to do. So we build that into our forecast just the way we build in other elements, other fiscal decisions. The contribution that's making to inflation one year to the next is relatively small. If you want me to put a number on it, it's in the range of 0.15%. Okay. So, quite small. But yes, that is something that we factor into our forecast, and it's built into the forecast I just gave you.
So one of the, we sit here in Alberta, and you have to look at the entire country. When you assess the health of the economy, are there provinces or sectors that you're more concerned about? I mean, it's tough to set policy that fits and addresses the different makeup of every province and region across the country. So how do you factor all that in to make sure you do the right thing?
Well, two comments there. First of all, we have a vast country. That's a great asset for Canada. And look, we always have some parts of the economy growing faster and other parts growing slowly, and those tend to change over time. If you look at inflation across all the provinces over time, what you see is, it can be a bit different one province to the next at any one point in time, but on average over time, provinces all converge to roughly the same inflation rate. So if you're hitting 2% inflation on average nationally, on average you're going to be hitting 2% inflation in the provinces as well. The second thing I'd say is that if you look across the country, yes, conditions can be a little bit different one province to the next. The industrial structure of our different provinces is different. But I think one of the things you've really seen through COVID and through the recovery is that actually it's been very correlated. We all had shutdowns. We all had a very serious recession. We've all experienced a really rapid recovery. The manufacturing sector was booming when we all wanted to buy goods. Increasingly, as things have reopened, we all want services. That's supporting the service sector. And then global demand for our natural resources has been very high. So really, all parts of the economy have been very strong. And that's when everything's overheated, that's how you get to 8% inflation.
Right. One of the things we talk about a lot is our lack of productivity, economic output per capita. And we rank at the bottom on a per capita basis in terms of output per GDP per capita. So how does the bank view the role of technological advancements to boost productivity? And what do we need to do in order to close that gap?
How long have we got, Deborah?
As long as you like.
Well, let me start with on a brighter spot, and then I'll come back to productivity. Okay. What are our big strengths? I think it starts with people. We're very good at growing our economy by adding people. We have a very well-educated workforce. We have high rates of labor force participation in this country. If you look at female participation in Canada, it's well above what it is in the United States. We are an attractive place for immigrants globally. We do a good job of integrating newcomers to Canada into our economy. And for all those reasons, businesses have been very effective in growing the economy by adding workers. We have a wonderfully diversified economy, abundant natural resources, vibrant manufacturing sector, big service sector. You've got all of those in Alberta, and that's a big asset. Our Achilles heel is productivity. We're really good at growing by adding workers. We're not very good at increasing the output per worker or productivity. And why that is a massive topic, and there have been more studies than I can name over, and it's not a new issue. It has been a long-standing Canadian issue. I guess what I'd say is that, look, there are some structural issues in the Canadian economy that aren't going to get changed anytime soon. We're a vast country. We have large, big transportation costs. We've got a lot of small and medium-sized businesses. We know small and medium-sized businesses don't have as many resources to invest in new technologies. They don't tend to be as productive as bigger companies. We also know, if we look at the productivity data, that export-oriented companies tend to be more productive than internally oriented companies. Well, that probably suggests competition is a factor.
Or the internal trade barriers.
Or internal trade barriers.
Yeah.
Yes. So, these are some structural things. We need to work on those, but, we're not going to change those things overnight. I think where we could change things a little quicker, and I am speaking to a business audience, what we saw through the pandemic is just how resilient, how dynamic, how innovative the business sector can be. I mean, you figured out how to serve your customers digitally when you couldn't serve them in customer. You figured out many of you figured out how to get large parts of your workforce working off-site at home. You invested, even in the depths of a serious recession, you were investing in new digital technologies to make those things happen. And I think we need to take that spirit, because one of the things we see is that investment in the business sector, in new machinery and equipment, new information technology in Canada is not as strong as in our competitors. You're running businesses, you know your businesses much better than I do. You also know your competitors aren't standing still.
Right.
And that productivity growth, that's what sustains our competitiveness globally. That's what pays for rising real wages. And fundamentally, that's what creates rising per capita standard of living.
And yeah, it offsets the demographic curve as well, right?
Yes.
Last April, you released your first report on climate risks and the effect it could have on the Bank of Canada's mandate. And the Australian Central Bank also weighed in recently, saying climate change was going to result in greater volatility and inflation, making the setting of monetary policy even more challenging. How are you looking at climate change affecting monetary policy?
Well, the first thing I want to underline is that Bank of Canada does not set climate policy. Climate policy, like fiscal policy, is set by our elected governments, and that's appropriate. We don't have a direct mandate for climate change. Our mandate is to control inflation. But climate change is a major force. I don't need to tell you, you're running businesses, you're seeing the impact on your businesses. It's a major force affecting the economy. We're seeing it already. It's creating more volatility, more forest fires, more floods. Not every forest fire, not every flood is caused by climate change, but the trend is that they're going up, and that is caused by climate change. There's also, we're in the beginnings of a large transition to cleaner growth. That's going to impact the Canadian economy. So, we need to understand that to do our job. We need to understand what are going to be the impacts of climate change on the economy. How is that going to affect inflation? Another one of our mandates is we promote a stable financial system. There are, if climate risks are not appropriately priced, there's a risk that when they crystallize, you see a very rapid repricing, and that could threaten financial stability. So we have been working with our prudential regulator in Canada, the Office of the Superintendent of Financial Institutions, together with a large number of financial institutions, to help them better assess the climate risks that they have on their balance sheet, so that we get a smoother transition and we don't get big bumps.
So, I just sort of referenced the comments by the Australian Central Bank. Just, on a broader scale, how often do you, talk to other central banks? We live in a global economy. Is there some coordination of policy direction, or is it, how do you factor in what everybody else is doing when you're setting interest rate policy?
Well, one of the nice things about being in the central bank business is you're not competing with your the other central banks. You're all kind of in this together.
Yeah.
So we do share a lot of information. In fact, this weekend I'm heading to Switzerland, where the governors are meeting. The governors of the major central banks will be meeting over the weekend to share perspectives. I mean, first and foremost on the economy, on how the path back to price stability is going. But we also do share information and analysis, and we even sometimes work together on global issues, and certainly climate change would be one of those.
Right. Just a hypothetical question, perhaps. If we didn't have to deal with the conflict in Ukraine, how much would we be still dealing with an inflationary environment because of the knock-on effects of what's happened from a supply chain, from an energy standpoint, from a agriculture standpoint as well? Or is that just
well, look, there's no question Russia's unprovoked attack of Ukraine has created a lot of global uncertainty. It has certainly impacted particularly global commodity prices, not just oil, but wheat, potash. If it'd be wonderful if the war was resolved for so many reasons. Economically, that would certainly be a very positive thing, but it wouldn't alleviate the excess demand in the economy. I mean, you're running businesses. I'm sure certainly what we're hearing from businesses is it's been hard to find all the workers you need. Yeah. We hear it is getting easier. You're catching up, but it's still tight. That rebalancing, if we want to get inflation down, that rebalancing needs to continue.
So one of the questions that's just come in is is there any other lever that you can use to address inflation, or is it's monetary policy and that's it?
Well, certainly the lever we have, our primary instrument is our policy interest rate. And yes, when the economy's overheated, when inflation's too high, we raise that. We've raised it very forcefully. It's working. We're not there yet, but we're going to get there.
Question about exogenous variables. Are you worried about an exogenous shock that could cause your plans for hopefully staying put or taking rates down change what your outlook is?
Well, the thing about exogenous shocks, the thing about shocks is, well, you can't forecast them because they're shocks. If they were forecastable, they wouldn't be shocks.
Right.
So yes, you always know that, as you move forward, there are going to be new events. There are going to be unexpected events. And monetary policy works with a lag. We have to try to look forward to where inflation is going to be when we take actions now. And of course, those forecasts can be knocked off when there are unexpected events. So you need to take what we sometimes call a risk management approach. And when inflation is above the target, and it's been above the target for a long time, you are more worried about those upside shocks to inflation than downside. Yeah. Because there is a real danger that if Canadian businesses start to believe that inflation is not coming back to the target, well, that's going to make it that much harder to get it back.
Did we get too used to low interest rates as a result of the financial crisis in 2008 and all the quantitative easing? There were times in the past, in the 50s, 60s, mortgage rates were about 6%, and that was considered not bad. Did we just get a little complacent?
Predicting where the sort of trend or neutral interest rate is going to be is difficult. I think when you look forward, I think it's our own models with the data we have say the neutral interest rate. And just to tell you, so the neutral interest rate is like this idea that economists made up, and it is sort of the interest rate, what the interest rate would be if the economy is roughly in balance, inflation's on target, and there's no big shocks.
Right. Goldilocks.
Goldilocks,
Goldilocks,
exactly.
yeah.
So, and we think that the neutral interest rate is somewhere between 2 and 3%. That's based on historical data. If you look forward, I think it's fair to say, when you look at some of the pressures, which I mentioned, climate change, aging demographics, rising geopolitical tensions, the need to make supply chains more resilient, those things, and also higher levels of government debt globally, so demand for more need to sell more debt. Those things could all be pushing the neutral rate up a bit. So when you look forward, although the data we have right now doesn't make a compelling case that it's changed, it seems more likely that it's going to be above historical estimates than low. So what does all that mean? Look, as we get back, as there's clear evidence that we're really getting back to price stability, yes, interest rates should come down. We're not there yet. It's too early to be thinking about interest rate cuts because we're not there yet. But we will get there.
Okay.
But I think you're running businesses. I don't think you should expect they go back to where they were in the decade between the global financial crisis and COVID. They could well settle at something higher than what we saw in the previous decade.
So a new normal.
A new normal.
Last question. What's the one takeaway you want to leave with the room today?
The one takeaway I want to leave with the room is that inflation has come down a lot, from 8 to around 3. The progress has slowed. The decisions are getting difficult. We know Canadians are feeling the pain of higher interest rates, but the target's in sight, the destination is worth it, and we need to stay the course.
And hopefully you don't get any more letters from premiers.
Just saying.